decision-making in the short-term business environment. There are many decisions that management must face in business. In managerial accounting, we cover some of those common decisions. For any business decision, there are many factors that are involved, but ultimately the decision should be based on the relevant data for that circumstance. Let's look at our first scenario, accept or reject the special order. If we decide to accept the special order, that will result in additional revenues, but also additional variable manufacturing costs. If we reject the order, there will be no additional revenues or costs. Note that fixed costs are not considered because we assume the special order will not require any additional equipment. Now let's look at our next scenario. Do we make a component or do we buy it from another company? The relevant costs for making the component are all of the manufacturing costs plus any opportunity costs. Opportunity costs are revenues given up because the company used the plant capacity to make the component. If the decision is made to buy the component, the relevant costs are the purchase price and any fixed costs that cannot be eliminated. Let's look at our third scenario. Do we sell the product now or do we continue processing it before selling the product? The relevant costs for selling the product are the current sales price and the current manufacturing costs. The relevant costs for processing further are the new sales price and the total manufacturing cost. These are the costs you should consider in a single product decision. The sell or process further calculation is a little different in a multiple product scenario. In this scenario, any joint cost of the product would not be considered relevant. Therefore, the relevant cost for the sell decision is the sales price, and for the process further decision is the new sales price and any additional processing costs. Our fourth scenario is, do we retain the original equipment or do we replace it with new equipment? If we retain the original equipment, the only relevant cost is the current variable manufacturing cost per year. The current book value and the original purchase price are not relevant costs. The relevant costs for replacing the equipment are the variable manufacturing costs for the new equipment and the purchase price, less any salvage value that can be obtained from the old equipment. The key in this calculation is the operating costs should be multiplied over the useful life of the equipment. And now our last decision scenario is to decide if an unprofitable business segment should be eliminated. If the segment continues, the relevant costs are the sales revenue, variable and fixed costs, or ultimately the net income. If the segment is eliminated, there will be no sales revenue or variable costs, but some of the fixed costs will remain. This could result in either an improvement or a deterioration of net income, which is why it's not always best to eliminate the segment. And now that you know the relevant costs, you can make great business decisions.